As the Fed heads west, the markets go south. Which markets are we talking about? I think probably equities front and center. Let's try and answer that question from a technical point of view. Katie Stockton, Fairlead Strategies founder and managing partner, joins us now. Katie, we've bumped up against the 200-day moving average on the S&P 500. Everybody got very excited about that yesterday. Do we roll over from here? Are the bears or the bulls in charge?
I think the bears are still in charge, believe it or not. And the 200-day moving average is certainly a widely followed level. It's not a major resistance level in our work. In fact, if you look back to the March relief rally, we did see the S&P 500 get above it for a few days. And we suspect the same type of thing might happen this time around. Our short-term indicators still do actually support the relief rally even after yesterday's pullback. And yet we're viewing it as counter trend and likely to fail within the next week or two. And that has nothing to do with Jackson Hole. It's simply based on the duration of the short-term overbought condition that's been in place. We have, as of earlier this week, we have a reading of 76% of the S&P 500 constituents having gotten overbought from a short-term perspective. It's not usually a sustainable reading. We've seen it at past minor peaks for the S&P. So we want to be mindful of any downturns in those short-term gauges.
So obviously then to pair with this going into next week is what about yields? So yields just keep falling. Many fundamental guys say that we need to see higher yields. What are the charts telling us?
Well, the technical guys and gals also feel that there's, potential for this trend to resume higher for yields. And we say that because the long-term momentum is very much the upside. And what differentiates this uptrend versus previous ones, including the one that peaked in 2018, is that it follows this major breakout from a multi-decade downtrend channel. And that's the difference this time around, meaning that the corrective phase that we're seeing here in yields is viewed as counter trend versus that breakout. There is, of course, some resistance that stalled the latest up move around 3.25. We think we'll see 10-year Treasury yields above that level this year for a targeted level of about 4% resistance, sometime perhaps even in the first half of next year.